Anla Cheng, Chair of the China Project. Today, I am thrilled to be speaking with Agnes Liu, our host and Senior Vice President at East West Bank and Director of the Private Banking Division. She will be speaking with Dr. Jason Xu, Chairman and CIO of Rayliant Global Advisors. I am currently in Vail taking a few days of holiday, but for Agnes, I am thrilled to be able to do this tonight, even from cold Vail, which is 15 degrees. Welcome to all of you, our community and pro members, as well as new attendees who are just getting to know us at TCP, the China Project. We are a one-stop shop on China, an omni platform that provides China business data and research, consulting, along with 7 newsletters, 7 podcasts, and 2 major annual conferences. We are award-winning, and I hope that as you navigate our website and get to know all that we offer, that you will also join us and become a member by subscribing to our pro membership and community. The topic for tonight is the US and China, twin economic growth engines. Can investors look forward to brighter days for the US and China markets? Tonight, our dynamic duo will discuss the risks and opportunities that lie ahead in 2023. Agnes Liu is not new to us. Agnes and TCP had our first webinar only a few months back when she hosted an event titled Art as an Asset Class. The more I get to know Agnes, who is a great friend, I am amazed by her breadth of knowledge about wealth management and investing, not only in the field of art, films, and theater, but also in finance, funds, and stock investing. When it comes to various asset classes, Agnes knows when is the right time to be looking at different investment opportunities to catch the wave. Agnes has multiple awards as Best Bank Investment Consultant by Top 20 program. She is also a terrific interviewer as she gets to the point, delves deep into issues, and gets answers to the bottom of any issues that helps make you decide whether to invest or not. No wonder she is quite famous and popular already in the West Coast and now quickly becoming so in the East Coast as well as we enter our second webinar together, this time on investing in China. Agnes, you are becoming not only an authority on investments, but also an influencer, if I may be frank. I have actually been a longtime investor in China during the last several decades, but this is truly a tricky and confusing time. On the one hand, China is opening up post-zero COVID, allowing climate talks to resume between US and China. Liu He, Vice Premier, made a statement at Davos just the last few days that China is open for business and boosting domestic demand, and that China's economy will return to faster growth. They're allowing tech IPOs to resume, allowing tutors to take place again after common prosperity regulations slammed the education sector, although there are still pretty stringent limits. And only yesterday, news of Beijing lightening up on the tech sector also meant Didi Sushing being permitted to have new signups, and 88 Chinese gaming companies were permitted to introduce new video games. On the other hand, we are learning about the shrinking population and falling birth rate, meaning fewer workers in the future, which could be a drag on their GDP potential of another COVID surge over Chinese New Year this weekend, thus further slow down in an already slowing economy to 3%. And of course, the chairman of everything, China and the US, are still in the midst of the strategic competition where we cannot see the end in sight. So where do we go from here? We see that foreign investors have already started to jump back in, and overall stocks have bottomed last October and are roughly up 20 to 30%. Tonight, Agnes and Jason will explore these issues, and I look very forward to getting some concrete guidance and answers once and for all so that we can align and improve our old wealth management portfolios. Thank you, Agnes and Jason, for a great discussion tonight. Please take it away, Agnes. Thank you so much.
Anna. Appreciate that wonderful introduction. You're the most prepared introducer and the least prepared speaker. So thank you so much for that. Thank you. Welcome everyone. I'm actually in Taipei for 2 days, and and Anna is in Vail, Colorado, and Jason, you're in Boston, right? Or you're on the Starship Enterprise?
I'm actually on Captain Picard's bridge.
I see. Great. Cool. So I think you have all read Jason's bio, so I'm just going to be very brief. Jason came to the US from Taiwan at 11, and after messing around in high school, he went to Caltech for his undergrad, Stanford for his business school, for MBA, and then UCLA for his PhD. And I guess that he couldn't exactly find a job and get employed after his PhD. So he decided to start his own company and co-founded research affiliate with the quant king called, who is Rob Arnold. So with that, they grew a very, very successful business. And together they managed about $180 billion of assets. They have primarily institutional clients, such as various sovereign wealth funds and various big pension funds. One of the most well-known company that they manage asset for is PIMCO, and actually Jason managed that all asset funds. So a few years ago, Jason spun off the China division of Research Affiliate and formed his own company, which is Rayliant Global Advisor. And to cut to the latest is now, I'm proud to introduce Jason as East West Bank's Chief Economist and Chief Investment Officer. So with that, Jason, we would love to hear from you what your crystal ball tells us, and then we'll maybe do that for about half an hour. And I would love to then have the chance to ask you some questions, and we'll open up for audience questions. Thank you, Jason.
All right, Agnes. Well, since we're talking about China and US, right, I'm going to use this opportunity to talk about something that we've been talking about all throughout 2022, and likely going to dominate at least the first half of 2023, which is US inflation. Now, how is that related to China? Well, very obviously, if you decompose the US inflation at its peak around 9%, roughly a third of that was driven by China's COVID lockdown, which has prevented Chinese factories from running, and of course Chinese ports from getting goods to the US. But that's only 1/3. What about the other 2/3? Right, the other 2/3, 1/3 of which is the Ukraine war. How is that related to China? So I'm gonna sort of peel the onion and talk a little bit about that. And of course, the other third is the Fed's printing of money, which of course, in the domestic US news, it's much more of a focal point around what has caused inflation. It's really the money printing. Now, how is that, again, related to China? Again, I'm gonna dig into that. And what I want to do is to really advance a thesis that at the end of the day, China is so intertwined with the US. Regardless of what happens domestically in the US, what happens internationally, the war always comes back to the interaction between China and US. And this will help us think about, is decoupling actually possible? And if decoupling is not possible, then what does it hold for the future of US-China relationship? And perhaps we can take that as a jump off point to talk about, well, how should we think about markets? So let me start. Let me start with the easiest one, which is the China lockdown. We all know that China, for most of 2022, locked down its economy. As a result of that, Chinese factories were running at minimal capacity, and the ports were largely non-functioning. So you had, these super tankers all jammed up outside the port of Shanghai. Goods weren't able to move around, and as a result, that was meaningful in terms of creating incremental inflation in the US. And once you realize that, at a time when inflation continues to be high globally and is still high in the US, I think it's useful to think about how dependent the US is on Chinese manufacturing, not just for our consumption needs, but also for managing our inflation. The minute China doesn't manufacture, US runs a high inflation. Right? And so once you realize that, this codependence, right, leads us to think about, is it actually possible for some kind of decoupling? Now, to understand that, I think first of all, we want to understand, just exactly what is trading, right? China trades with the US. And, naively, you might think, oh, China trades with the US. It's US buying goods from China. So in some sense, China is heavily dependent on US. Now, perhaps I think it's useful to understand, no, it's really two sides of the same coin, right? Trading is literally, China producing more than it needs and the US consuming more than it should, right? That is the two sides of trading. And you can't have one without the other. China saves too much, right? It doesn't consume what it produces, and the U.S. saves too little and consumes more than what it wants to produce. So one needs the other, for things to continue. Now, it's of course a unhealthy relationship, which I'll get into more. But again, if you think about in almost a comical term, who's getting the better of the deal, right? When U.S. trades with China, well, what does China send to the U.S.? China sends to the U.S. Goods and services that come from over mining, over polluting its own land, long hours in the factory. And in return, what does US send China? In return, US sends China paper, right? Paper prints. In fact, we're so lazy today, we don't really even print paper. We just send over some digital ones and zeros. If you think about it in that sense, it's not obvious that the US isn't getting the best of the deals, right? US sends digital ones and zeros, and China sends over a lot of very difficult to manufacture goods. And so that takes us to friendshoring, right? If you think of friendshoring and you put that in the context of US is really getting a fantastic deal, right? It's generating, digital ones and zeros, get physical goods, to friendshoring, meaning walking away from that and asking someone else to take that deal. Now, clearly, if you think about who might want the other end of that deal, increasingly you're seeing more advanced Asian economies like Japan, like South Korea, like Taiwan. They're less interested in taking those deals anymore. And then if you think about, well, could that be done? Could friendshoring be with Mexico, with India? Could friendshoring even mean bring manufacturing back to the U.S.? And so let me sit on this topic, simply talk about the U.S. trying to bring back semiconductor manufacturing. I think one useful thing to sort of recall here is it's never the case that the U.S. doesn't know how to make something, right? It's not that China knows how to make something the U.S. doesn't. So the issue is about technology, is about IP. The issue is U.S. doesn't know how to make anything China makes at the same cost that China makes it, right? And the same thing with TSMC and semiconductor chip manufacturing, right? U.S. knows how to make semiconductors perfectly well. Why does it need Taiwan to make its semiconductors? Because Taiwan makes it cheaper. The minute you move anything back to the U.S., right, it's no longer cheap, right? It doesn't solve the problem, right? So anytime you think about friendshoring, I think we just have to be a little realistic about, do any of our friends want to make goods really, really cheaply and then send it to the US for some digital ones and zeros? If most of our friends don't want that trade, in fact, most of our friends want to be on the other side of that trade, then it's very, very hard to move away from China. And then I think the last year with the high inflation driven by the factory of the world, China shutting down, it's sort of a good reminder. And let me sort of segue from China locking down, as one part of the inflation story to the next, which is the US Fed printing money, right? So how is this related to China? Well, first of all, let's just think about the US being $32 trillion in debt. How do we get that far in debt? Well, it's because we keep printing money, borrowing money to buy things we don't make, right? That's how one gets into debt. Now, it's not all owed to China. A lot is owed to the Japanese, owed to Taiwan, owed to South Korea, and then a good chunk of that is owed to mainland China. Now, what's most interesting is the U.S. has printed lots of money, got in debt, manufactured too little, and kept a very low interest rate to encourage firms and individuals to continue spending. How has it been? Like, that's only contributed 3% of the 9% inflation. And how has it been that over many, many decades, that U.S. has now run a much scarier, higher inflation? Well, the answer to that is China. China absorbs U.S. inflation. How does China do so? China, without the U.S., would run deflation, right? Why would China run deflation? Because Chinese people work super long hours, good at making stuff. They just don't spend any money, right? So if everyone is working on making stuff and no one is spending money, you have deflation. And so China has to fix its problem of, working too hard and consuming too little by finding a partner. An ideal partner is US, right? I've been joking, and it's really not a joke, right? This is really an abusive, codependent relationship. One spends too much money, one spends too much money, one spends too much time making money, right? And so if you think about that, China needs US to solve its deflation. US needs China to solve its inflation. These are big, big social problems. And they're completely aligned in wanting both a strong dollar and wanting the dollar to continue to hold its value, right? Because if dollar is weak, Chinese goods become expensive and it weakens the China export sector. If dollar doesn't hold its value, China holds trillions in dollars, right? Then it's the digital, one and zeros it gets from the US becomes worthless. And China certainly, don't want to be, storing up so much US dollars only to see it devalue and become worthless. So the two are actually quite aligned in ensuring the dollar continues to be strong and valuable. And so I think that's sort of useful to understand that you're not looking at two opposing partners in a relationship. They may occasionally fight, but they are certainly in a relationship where they mostly see things the same way and need the same things. Okay? And again, if you put politics into the equation, every US president, it's been a long time where this is the case. Every US president would prefer to solve problems by printing money, giving them away, create cheap liquidity, and through cheap liquidity, engineer easy prosperity, right? That's the best way to show short-term growth and the best way to win a midterm election and win the presidential election. And because of that, no president want 2022, right? No president want to experience a situation where that easy, cheap liquidity strategy can't work because China isn't manufacturing. And so you run an inflation. As a result, you have to hike your rate, increase pain to the economy and become extremely unpopular, right? So given that no president want that, it's unlikely that there's going to be sustained political will to get into a fight with China and to really rotate away from China and seek out either new manufacturing partner or bring manufacturing back to the US, because those are just not sort of feasible solutions. Right. So let me now move to the third contributor to the US inflation, which is the Ukraine war. Again, you're going to ask, well, how does China play a role in that? Well, China, again, is critical in this Ukraine war. Now, let me just talk a little bit about Ukraine war and kind of my crystal ball as to how will that end. Well, my guess is it's not going to end anytime soon. And the thing to really think about is, Putin isn't going to pull out. That's both ego and probably personal career saving move. Right? Just can't admit defeat. Russia cannot. What about the U.S.? What is the U.S. interest in all of this? Is the U.S. particularly interested in Ukraine and the Ukrainian people? Maybe some politicians are. Certainly, a lot of Americans are sympathetic to it. But when U.S. think about its own strategic interests, it really is much more interested in the weakening of Russia without starting World War III. So fighting a proxy war through Ukraine and slowly bleeding dry Russia is probably not a bad outcome for the U.S. When it's all said and done. So it's unlikely that we'll see a shift in that war. So then where does China come in? Well, China comes in here in that simultaneously, U.S. has signaled and demonstrated to China what might happen if China levels up its aggression toward its neighbors. Obviously, particularly here, we're talking about the island of Taiwan. What more than anything else we've seen is the sanction and its impact on both the Russian economy, but more importantly, on the offshore wealth of the Russian oligarchs. Again, all of that just serves as additional friction to various ranking members of the Communist Party, various power brokers in Beijing, to ensure that there's a more balanced dialogue, that it's not all the hawkish talk, the dovish voice. We get a balance, given what's been demonstrated by US and Western sanctions against Russia. And of course, in that whole process, something more interesting has happened. Dollar has been weaponized, and that's a term of art. It just means the dollar has been used as more than a neutral currency, but it's used almost as a economic tool against someone who doesn't follow Western rules, right? So an analogy is if you borrow a lot of money from a bank and then you discover the bank president's son has cheated on a college exam, and just out of anger against the lack of morality, you decide to not pay back the debt for the bank, right? That would be sort of basically weaponizing your debt. And what we're seeing is sort of Western countries as the biggest debtors. That's what happens when you issue currencies, is you just become a big debtor to the rest of the world. And so the West will now realize, hey, dollar, holding the dollar is almost in a way pledging allegiance to the US, right? You will do as the US wish you to do. Otherwise, all of your dollar may be worthless, right? You will lose the ability to access global markets. And that, interestingly enough, has driven almost the opposite outcome of, I think, what US is strategically intended to, right? US is hoping this encourages everyone to ally themselves with the US hegemony, the dollar hegemony. But instead, what the US didn't anticipate was, people who were strong US allies, or at least certainly more anti-China, have now realized, well, they're not 100% committed to do exactly what the US want always and forever. So you're even seeing India deciding, and India's been, a long, sort of quasi frenemy with China, right? A constant border dispute, and certainly they compete in the emerging market basket. Even India has declared, look, India is not on the fence. India is not taking side. India is on the side of India, and for the good of India, India is going to start trading with renminbi, despite its relationship with China. And certainly, the Middle East has demonstrated, it is now exploring trading natural gas and crude oil using the dollar. And so this has sort of fallen into President Xi Jinping's lap, right? He had always wanted to be the leader who's taken China to the international stage, right? Mao Zedong formed China, Deng Xiaoping brought prosperity, and President Xi Jinping was going to be the one who made China a global player. And the first step he wanted to accomplish was to make renminbi a global currency, one that could potentially rival the dollar. And all of a sudden, he's leapfrogged the yen, the euro, the British pound, because those currencies are all highly correlated with the US, right? They're all part of the dollar hegemony, because these are people that are aligned very tightly with US policies. And so what we're seeing is, China, both, getting some help with its domestic conversation, where the Dove factions are gaining some strength and voice out of the fallout of Ukraine, but also with the renminbi becoming a global currency, that is such a benefit that it also further discourages China from isolating itself and from being less of a collaborative player on the international scene. So, what we've seen, post the Party Congress, is we're seeing kind of global powers really extending out olive branch back to China. You got Germany visiting China. This is where Germany recognizing, because of the war in Ukraine, it cannot afford to further alienate China, right? Because Russia supplies gas and oil, Ukraine supplies food. Those are in short supplies. It's probably not a good idea to further, irritate the people who supply all the other high quality manufacturing goods that you need. And that has been, again, a boom, forcing global powers to not, align so tightly around US, recognizing that in times of distress, it's not the consumer who's king. It's really the manufacturers, those who control production and raw resources, who are king. And I think that's been shown in spades in recent events, as most countries are much more willing to extend an olive branch and reestablish tie with China despite US prodding. So let me sort of quickly conclude, and then we can get into the conversation with Agnes. Decoupling is going to be very, very hard. US and China simply need each other too much, and they're also too big. So decoupling, where are they going to go, right? Where's China going to find so many consumers, and where's the US going to find such a large global factory? I know a lot of people want to think about the relationship between US and China as Cold War 2.0, but that's definitely the wrong analogy. A closer analogy would be really the rise of Japan in the late 80s, early 90s. If you go back and read a newspaper, most of it was very anti-Japan, very negative, great fear around the rise of Japan They said Japan was the biggest threat in Asia, given Japan's history as a aggressor and invader. Right, we're hearing all that same narrative, and I would say, look, the reality is the rise of Japan was much more of an economic discomfort for the U.S. that both needed each other too much to let that tension get too far. And you can ignore most of that media. I often tell people, if you try to learn about China from Western media, it'd be like learning about the Democratic party policies from watching Fox News. And so you can ignore most of what you hear in sort of Western media because of its own bias, and just focus on the fact that these are two of the world's greatest growth engines, or continue to be. One is a great innovator in the US, one is a great engineer in terms of taking those innovative ideas and turning them into low-cost, high-quality products. And the two need each other so much, and the world needs them so much, that it's unlikely things will go out of hand. A little bit of fighting here and there, bit of attention, and we're gonna have to put up with that. But by and large, these two growth engines are going to propel the world forward and be good for you to diversify across both. All right, back to you, Agnes.
Great, thank you, Jason. Really appreciate the perspective. I have so many questions, and also I'm thinking, how do I, for myself and also for our clients, how do we put what you share with us into actions? And I also see some questions that from our audience. So what I'll do is I'll ask my questions first to be selfish, and then I'm going to share the questions from the audience. So Jason, one of the things I want to know is, how does China actually pivot from a zero COVID to this opening up policy?
Yeah,
and how is that progressing?
Yeah, so clearly the COVID lockdown policy, the draconian lockdown, was, in hindsight, a bad policy. Now, again, it was not completely unreasonable, but certainly if you recognize at some point you do have to open up. So all the pain you're trying to avoid, you're just delaying it. So, might as well bite the bullet and then open up and let human immunity and evolution take care of things. Now, the abrupt opening up, I think, was probably also a challenging thing, right? Something that's a bit more staged, may have sort of reduced, I would say, the kind of fear and anxiety that ensued. But I think the most important thing to really focus on is, look, the COVID casualty, right? That's, the percentages we've seen those data statistically across the world. It's impossible to avoid. Doesn't matter how well you manage it, right? This is kind of a minor plague upon the world, right? You can manage it to reduce damage, but you're not going to have zero death, and it's always going to be a human tragedy. So I'm not going to talk about that. What I think is sort of more missed is the protest that's led Beijing to pivot from locking down to opening up. There's something really important to pay attention to, right? Because there were a lot of fear, right? And this is why there was that capitulation selling right after the Party Congress, was there was fear that the pride of Beijing, the ego of perhaps Xi Jinping and his advisors would cause them to double down when people protested and argue that it was a failed policy, the wrong policy. And that is not unreasonable to assume that could happen, right? We've seen political leaders, both elected and unelected, to oftentimes let pride get in the way. But interesting enough, Beijing actually found an off-ramp. So instead of, police or the army, going to battle with the people, Beijing simply pointed to the incompetence of local administration, corruption, local administration with the pharmaceutical companies and testing labs, that's led to this sort of wasting of public resource and an ineffective execution of Beijing's dynamic COVID policy. So, Beijing created this off-ramp and exited out of a tough situation without losing face, right? They didn't skip a beat, right? All of a sudden they laid off blame and pivoted. And the opening up was always going to happen. Everyone was sort of expecting, what would be the catalyst, what would be the excuse. And Beijing took one as soon as it found one. And I think that was quite positive. Something that people probably expected to go much worse didn't happen. So that reflected some wisdom, and I would say tremendous amount of sort of self-control and cleverness and tactics. And I think that's encouraging.
Great. So maybe coming back to the US a bit, this Fed tightening, how much are we going to, how much more are we going to see? And also, I think people are concerned about over tightening. So and are we like heading for a soft landing, hard landing? What's your view?
So for sure, we're heading for a hard landing. So I'm going to start there. And this is something that, all of the voting members of the Fed have known for a long time. Now, they just couldn't say it because we had the midterm election last year, and that would have, been quite negative, and the Republicans would have attacked the White House on the double if the White House is going to engineer a recession, right? So, the Fed couldn't suggest that to contain inflation, they would have to increase rates to such a level that it would create recession, and of course, then the necessary unemployment, all of which I think we're going to see about Q2, mid of this year. So how much higher are we going to see rates go? We'll probably see one additional hike. And that's because right now, even though we passed peak inflation, so, we had peak inflation last year at about 9.3 on CPI. It's come down to 7, and we expect to gradually go toward 5. And maybe by end of this year, we might, start of next year, we might see something closer to 3. But it's still at a level right now that's much higher than what I think people are comfortable with psychologically. So the Fed simply has to sort of signal its focus, its exclusive focus right now on fighting inflation to the exclusion of everything else. So we're going to see one more hike, and it's likely to be a 50 basis point hike just to make sure people take the Fed seriously. Now, the funny thing is, as I mentioned, right, 2/3 of our inflation are actually attributable to sort of forces not under the Fed's control. Be it the COVID lockdown in China, which is working its way out, and it doesn't require the Fed to do anything, and the war in Ukraine, which is not getting any worse, which means expensive food and energy prices will sort of stay high, but they're not going to increase. So inflation from those two sources are actually going to melt away very soon this year. And so really, I think the Fed's sort of in the clear in terms of inflation under control, both because of the high cost of capital, but also because the other two factors are just taking care of themselves. So I think by mid-year this year, inflation would gradually be a non-event, and the Fed will declare victory. And we're very soon, unfortunately, going to have to focus on a recession that's taking hold and worsening job numbers. And probably by the end of this year, the Fed is going to full on pivot to a more dovish tone, and it's going to be much more focused or entirely focused on job creation, turning the economy around to line up with the presidential election that's coming forth in 2024.
Got it. Thank you. On that note, I have a lot more questions, but I got a message from the that I should start asking audience questions because they keep coming in. So let me go to that first, and in case we have time, I'll come back to my questions. So the first question is from David, and the question is, internationally, it's suggested that the CCP is interested in climate because it affects its power and security of the CCP. That said, what is the outlook of green energy market in China?
So, since President Xi Jinping signed on the Paris Accord, pledging that it will hit carbon neutrality by 10 years after other developed markets, so by 2065, I think. That has now become the mandate, right? It's what the president has pledged to, and the party sort of mobilized to create policies to ensure that China will sort of hit those targets. So it's now gone from, is this good for China, to, hey, this is definitely good for your personal political career, to not disappoint, this major mandate. Because of that, we're seeing major subsidy, and we're seeing a lot of industry funds throwing billions of dollars toward anything that's around renewable, green. And again, what we've seen is, China now has overtaken really the rest of the world in terms of EV manufacturing, has really taken the key leadership position in battery technology. And I would not be surprised, over time, China becomes the biggest manufacturer of automobiles as the entire world transition into electric vehicles. Because if you think about it, electric vehicles at the end of the day is much more like a cell phone and probably easier to assemble than the cell phone, because it's just a battery, software and some other simple components around it. Other than the fancy Italian leather you might want inside the car, everything else Chinese pretty good at making, right? So China is actually extremely skilled and experienced in assembling, large and small electronic, high-end electronics that requires big battery. It makes most of the world's cell phone. I think soon it may make most of the world's EVs. And so this happens to line up both in terms of China's sort of green initiative, but also with China's ambition in continuing to be the world's sort of high quality, high value add manufacturer. And so I think there's actually big risk for US automakers in that traditional automaking technology is not at all conducive to the making of EV technology.
Great. Jason, I'm just amazed because we can ask any questions and it's like you're like a walking encyclopedia. Do you ever sleep?
No, I'm actually just typing in your questions into chatbot from OpenAI and reading off what it says.
Great. All right. Good plan. Okay. So the next question from David. David, I don't know where you are and who you are, but I would love to meet you because you ask great questions. So another question from David is, in terms of China wanting to grow as a global shaper, why has China not taken RMB to float internationally and grow the RMB international markets?
Well, China has tried really, really hard, and it just never had any success. Because again, if you think about holding a foreign currency, right? The biggest reason for holding a currency is you have to have a belief that that currency can be converted into something useful, right? And so we know renminbi is a restricted currency. So if you hold a lot of renminbi, you're kind of going, well, what can I use that to buy? I can't buy it anything else from anyone else because that's not freely convertible. I can't just convert renminbi into another currency. And then so the convertibility and the tight government control on it cause you to doubt, like, can this currency be converted into something of value in the future? That's something that we never question about the dollar, right? Everyone takes the dollar. You can use dollar to buy everything everywhere. You can always convert it to any local currency you want. So the convertibility issue of renminbi has really been what's holding it back. However, recently, global powers, right? Middle East, right? They still control the bulk of global sort of energy resources. Have said, look, you can use renminbi to buy crude oil, right? You're seeing people willing to settle trades using renminbi, including India. So as more people are willing to let you use renminbi to trade with them, let you settle trade with renminbi, then other people say, hey, look, I don't just have to hold dollar. I can hold renminbi just in case dollar, is weaponized and then I'm not somehow by accident or by direct impact forbidden from using a dollar. I can use renminbi to buy what I need in global markets. So this acceleration of renminbi becoming a global currency is really not something China could force on the world. It really requires sort of major global powers which control important resources and are big export countries to agree to let people buy their goods and services using renminbi.
Got it. Thank you. Well, next question is the dearest to my heart because even though I live in the US, but I'm a Hong Kong girl at heart. So next question is about Hong Kong. What role do you see Hong Kong having going forward? It has long been an interface between China and the West, but with the political development, slow reopening, and many companies moving operations to Singapore, the outlook looks uncertain in the coming years. So I would love to hear what your views is on that.
And I hope I have better news, but I fear, because of COVID, because of sort of Hong Kong's very delicate relationship with mainland China, because of the fact that Hong Kong is really no longer arm's length away from mainland China, the most important industries, wealth management in Hong Kong, the sort of international financing and banking has decided to move away from Hong Kong to predominantly Singapore and some to Taiwan, some to Australia. I don't think that trend is reversing. And also other people who said, look, if I'm happy to take China risk, if my belief is that Beijing will do sensible things, it wants to be better global citizens, it'll only be more transparent, more fair, more open, then why do I need Hong Kong as a gateway, right? If I'm willing to take China risk, I'm just gonna go take it directly in Shanghai. So depending on which camp you live, right? Either you just don't think there's risk or you think there's a lot of risk, Hong Kong no longer makes sense as a choice.
Okay, that makes me want to cry. All right, so anything Hong Kong can do?
Wow, that I wish I have a good answer. I don't know if anyone knows of a good answer.
Okay, well, at least for March this year, Art Basel is happening. So I'll be in Hong Kong. So if any one of you are coming to Hong Kong, please let me know. I would love to host you. Okay, so next question is from Charlie Wang. What are the signs that the US and China governments are lowering tensions? So what would be things to watch out for? It would seem that the US is becoming more aggressive on China trade restrictions, and China seems to be more driven to be self-reliant and independent, in addition to the aggression in the South China Sea.
Yeah, so I would say, a lot of what we saw last year, 2022, was driven by the fact that China was having its own version of an election, right? Re-electing President Xi Jinping to an unprecedented third term. So a lot of what China needed to do, or what President Xi Jinping needed to do, was to signal what needed to be signaled for him to gain full support. And military support is clearly absolutely necessary, and to signal and to sort of exude more nationalistic, patriotic messages, I think was critical for winning and solidifying support from the military for President Xi Jinping to look strong, to look aggressive, to give US the middle finger. And similarly, I think US had midterm election last year. So, I think the tone toward China was amped up as well, including the Pelosi visit to Taiwan, and, shifting from one China with strategic ambiguity to recognizing Taiwan as a separate entity, again, under the veil of strategic ambiguity. So I think we've seen some of that being pulled back, not everything. And then you're right, the sense that the relationship between China and US are going to be tense and going to be tense for a long, long time. I don't think there's a catalyst for reversing that anytime soon. But what we're also seeing this year is there's some de-escalation, right? Beijing has agreed to let the SEC audit Chinese companies onshore who are dual listed in the US, and that's making a huge concession, right, to US regulator. A number of concessions China has made to attract international capital, including what Liu He had recently spoken about at Davos. So I think there's a softer stance post-election and with a new focus on growth. And we're seeing, Europe responding in kind. And I think US recognizing that it doesn't have a strong sort of alliance from its European allies, will probably, soften its stance as well. But again, I agree with you that the relationship is going to be tense and colder versus the last 10 years.
Got it. Thank you, Jason. So the next question, is China going to loosen its capital controls or fix its currency to gold to increase its appeal to foreigners?
So, the renminbi, if China wants to increase renminbi's appeal to foreigners, it will simply loosen forex control and allow greater convertibility. China is now ready to do that. There's the very simple reason that China recognizes that the best way to deal with corruption and corrupt officials is as long as you maintain convertibility or lack of convertibility, people can't leave, or when they leave, their money can't leave. And so that's sort of a gateway against corruption and against people leaving country with mass amount of wealth. And I don't think China is ready to abandon that policy. And there's the other part, which is once you have full convertibility of your currency, it becomes very difficult to protect your own financial institutions, right? Because companies in China could now go internationally to borrow in US dollars and Japanese yens and then FX it back domestically. So if Chinese financial institutions are not going to be globally competitive, all of a sudden it's going to lose all these deals to foreign companies. And we know today, part of CCP's ability to control companies is it controls financing, right? All the big major banks are state-owned. So whether you get a loan or not depends on your relationship with the state. And I don't think the CCP is ready to sort of give up that control. So there are really two things going on there, right? One is control and one is the viability of these state-owned banks, right? Can they compete nationally? If they can't compete internationally, then opening up the currency could significantly weaken their business.
Got it. Thank you, Jason. All right, next question is from Candace about Singapore. Actually, I was there last week, and my gosh, hotels in Singapore are so expensive these days, and it seems like there's like conferences going on every single day. So the question is, how's China's relationship with Singapore? How will China respond to all these wealthy people and billionaires moving their money to Singapore?
Well, Singapore is the new Switzerland. So everyone's relationship with Switzerland, and thus by extension to Singapore, will be very positive, right? First of all, Singapore, recognizing it wants to be the new Switzerland, is doing a fine job at it. It will do its very best not to irritate anyone, particularly not China, right? And China recognizing that, look, Singapore is going to be a good player, right? It's going to be fairly neutral. It's going to be very circumspect and very, politically correct, and that, it's a safe haven for everyone's money, right? Not just people who are moving away from China to find a safe haven for their money, but also people who are firmly in control, but who have money and want to park them offshore somewhere for safety. So, I think Singapore is going to do extremely well, establishing itself as the Switzerland for Chinese billionaires and Asian billionaires.
Great. On that note, like I read somewhere that Jack Ma now moved to Japan. So what's the deal there? And also, like, what's going on with all these like Pony Ma and all these well-known tech billionaires?
Well, so there are a few things to cover here, right? I mean, to be perfectly balanced, right? Because I think we hear one side of the story, which is, hey, these entrepreneurs who's created great wealth, who's brought perhaps a lot of prosperity to China through their innovation, building great companies. People are very sympathetic to them, right? It's like, oh, they got a raw deal, right? The state's interfering with their companies, and in the case of Jack Ma, perhaps targeting him, or perhaps forcing him to relinquish control of his own company. Again, there's a lot of truth, and then I can understand those sympathies, but I think to be perfectly balanced, right? It's also useful to understand, and perhaps this is a bad analogy, but I'm gonna use it anyways. I know I'm being recorded, so I should be more circumspect. But you make a deal with the devil, you gotta honor your deal, right? I mean, let's not confuse Jack Ma as Jack Bezos, right? Let's not confuse China tech billionaires as the comparable tech billionaires in the US, because look, the Baidus, the Alibabas, the JD.com, the Tencent, they didn't become that way out of free market competition. They became that way because Beijing says no foreign competition for you guys. You have protected turf. So whatever you can imitate and learn from the US, you get a head start, or you get a infinite head start until you get it right. So look, the state did provide a lot of sort of protection for these firms to grow and get big. And certainly many of them actually receive generous state funding and local government support as sort of incubation, venture capital funding, or just subsidy. And so I think it's important to recognize that a lot of very successful people in China obviously work hard, are super intelligent, super capable, but let's not forget the condition that they were allowed to thrive because the Amazons, the eBays, the Googles, the Facebooks were kept out. And so if the state now says, we got a deal and you shouldn't fight, the hand that feeds, and you should sort of honor those deals, there's something to that as well. The state, making demands as someone who's sort of a kingmaker and played a huge part in the success of these companies. Now, again, that's just sort of ensuring everyone sees both sides of the story. Clearly, it is a concern. If the state can interfere too much, and it can both advantage you and disadvantage you, it does create risk to entrepreneurs, create risk to investors. And I think that's what sort of added to a lot of the global negativity toward investing in China. And that is something that China probably wants to look to address, right? Both don't be so protective of its economy, and also recognizing that when you're very protective of your economy, and then you want to reverse that, you're gonna get a lot of flack too.
Got it. Thank you. So next question from Charlie Wang. What is your view on the property market in China? Will there be a revival, or is the government remaining strict on speculation and excess debt?
Yeah. So if there's one fascination Beijing has, it is how to avoid a Japanese bubble, right? A Japanese experience, because Beijing sees Japan only failed to emerge as an equal to the US because of that spectacular real estate bubble that bursted and basically plunged the economy into a 40-year recession. So Beijing recognized how dangerous it is to have excess leverage in real estate. As a result, if you look at Beijing, right, Beijing is always very leery to provide cheap liquidity, cheap capital, especially when directed toward real estate, right? Not only has it made it difficult to buy a second property on debt, right? A lot of times people who buy a second property, they can't get financing. Sometimes they're even outright, disapproved, by the state for making that purchase. And even if they were allowed, getting financing is exceedingly difficult, it's exceedingly costly, all of which is because they don't want to repeat the Japanese experience. So the only reason you would buy is you have, full cash and you didn't have a better place to spend it. It's tried, and I think it's successfully deleveraged the developer sector, right? So it's deleveraged the developer sector. There's not a lot of leverage in the homeowner sector. So really, there's not a lot of risk in that market. So it blowing up and destabilizing China, I think that's just overhyped. It's something that Western media write about when they have very little understanding of how things work. And really, Chinese people hold real estate probably much more like Indian people hold gold, right? It's more of a store of value rather than a leverage investment for income. So once you recognize that, I think it's a little easier to understand, the Chinese fascination with buying apartments that they don't live in and don't rent. Now, there's been a bit sort of a pullback in prices. Now, in part, it's because the state has put on very draconian pricing caps, right? So it's just disallowing sort of new inventory being priced high. And that's sort of causing people to have some concern, either speculating in real estate, because then it may not be such a great store of value. If this is a store of value, I can never increase in price, right? They might as well go buy art. They might as well go to Hong Kong, Basel and buy art than buying real estate as a way to display wealth and a store of value. So I think, when the state is so obvious in its intention that it doesn't want real estate prices to go higher because it's such a social problem, I think it's likely then that kind of conviction is going to force a lot more money into finding alternative investments, be it in art, be it in the stock market.
Great. So Jason, we have 6 minutes left. I have 2 last questions from me. One is, can you share with us what's going on in the private equity market in China? Because a lot of US endowments and so on have been investing in China, right? So then the last question is, with all that you've shared with us, what's an investor to do?
Okay. So I mean, private equity market used to be the biggest market in China. It completely dwarfs the public equities market, and which is kind of surprising, right? Because that's clearly not the case anywhere else in the world. And part of that is because a lot of companies that's being incubated by private equities were looking to IPO in the US, which of course is a much bigger market that can support much higher market capitalization, much higher valuation. And of course, in early days, this was all started by the Yale endowment model, and of course the famed David Swensen, and of course Zhang Lei, who learned much from David Swensen and really kind of replicated, and then really kind of started the VC revolution in China alongside Sequoia China. And they got home runs, or easy home runs, right? Like with the state protecting that market, you invested in hardworking, intelligent people, and you're gonna hit some Alibabas and Tencents and JD and NetEase, and so coming off of those humongous returns, right? It was very easy for them to raise money internationally and domestically. So massive private equities market, that's all dried up, right? So people are finding it hard to get exits. People are getting down rounds, and the reason for that is, well, it is very hard now for Chinese companies to IPO in the US. First of all, the US is having its own bear market. Right? Valuations come way down. So it's not just Chinese company having a hard time IPO in the US. I don't think anyone in the US wants to go IPO in this market condition. And second of all, the uncertainty when it comes to the US regulators' willingness to approve, and even after listing, so issues you might have with compliance, getting blacklisted, caught in between US regulator and Chinese regulators, right? That just exceedingly unpleasant. And that's going to reduce appeal for IPO, for investment bank to underwrite you. So I think that's had significant negative impact on the private equity markets in China. That's just the route to the US being cut off. And of course, we know domestic market, IPO has always been slow and difficult, right? So the approval base rather than the registration base. So there's just lots of reasons the state doesn't approve you. In particular, if you're a tech IPO, you're generally not profitable. And in China, it's very difficult to get approved if you're not profitable and don't have a model to quickly get to profit. So that's really what's hurting the private equity market there. So the good news is it does mean a lot of money is, again, going to shift out of the private equity market, which used to capture a lot of the capital. A lot of money is forced out of the bank. Now interest rate in China is low, and all those high yield trust products that supports the real estate developers, that's been disallowed. So more money is being pressed out of that market. And then the real estate market itself, right, as a store of value, has become sort of less popular. People view that as a bit more risky, with the state really playing a very strong hand there. So money's going to come out of that. Where's it going to go to? I think wealth management in China is entering sort of inning number one, right? China is really trying to build wealth management the way the West has it, the way the US has it, trying to encourage 401k, trying to encourage banks to start wealth management, help investors not speculate and gamble in stocks or buy single funds and churn them, but buy a diversified portfolio of funds and hold them for the long run. So I think you'll see money being directed there. There's going to be a lot of support, policy support, a lot of sort of state pressure for that to come to fruition. And I think it's going to be good, right? Because it's going to foster long-term disciplined professional capital, and that can only be good for the equity market. And perhaps China might see what the U.S. has experienced, with the rise of its wealth management market, that a slow, multi-decade bull market that the S&P has experienced. That might be in store in the future for China. And as an investor, being long China makes sense. Right now, everyone hates China. Everyone who has any doubt about China has sold out of China. And this is why, with a little bit of good news, in fact, you don't even need good news in China. You just need less bad news, right? You need no draconian lockdown. You need no police beating up protesters, things like that. And you could have a catalyst for a stock market rebound. So that's in the short run, right? Just buy when there's fear, and there's definitely a lot of fear, a lot of negativity, both domestically and internationally. But in the long run, China's a great diversifier, right? You got US on the one end, you got China on the other end. You kind of got most of the world's GDP covered there.
Great. Thank you so much, Jason. We are finishing right on time. So thank you, everyone. I hope you enjoyed this session, and I hope to see you again soon.